Is a stock market crash coming? Many experts believe it is. Are you ready? Protecting your investments is crucial in uncertain times. We'll explore the warning signs in the market. You'll learn about historical crashes and what we can learn from them. Most importantly, you'll discover actionable steps to protect your portfolio. Don't wait until it's too late. Get informed and take control of your financial future. This is your guide to navigating market volatility. We'll discuss proven strategies to help you weather the storm. You'll learn about diversification. This is a key strategy to reduce risk. We'll also explore safe haven assets. These can provide stability during turbulent times. Don't let fear control your investment decisions. We'll equip you with the knowledge and tools you need to make informed choices. Let's get started. The stock market is sending mixed signals. Some indicators suggest a crash is possible. Others point to continued growth. It's important to stay informed about the latest trends. Economic data is also mixed. We see strong consumer spending but also high inflation. These conflicting signals create uncertainty. This makes it difficult to predict the market's direction. Investors are watching closely for any signs of a downturn. Some are already adjusting their portfolios. They are seeking to protect their investments from potential losses. Navigating this environment requires caution. It also requires a well-defined investment strategy. Inflation is a major concern for investors. Rising prices erode purchasing power. This can negatively impact corporate profits. The Federal Reserve is raising interest rates to combat inflation. These rate hikes can slow down the economy. This can lead to a recession. Investors are worried about the impact of these factors on the stock market. They are looking for signs that inflation is cooling. Some experts believe inflation has peaked. Others are concerned it will remain elevated. This uncertainty is fueling market volatility. It's important to understand how inflation affects your investments. We'll explore strategies to mitigate this risk. Geopolitical risks are also adding to market uncertainty. The war in Ukraine is disrupting global supply chains. This is contributing to inflation. It is also creating uncertainty for businesses. Tensions between the US and China are another concern. Trade disputes and geopolitical rivalry could impact the global economy. These factors could trigger a stock market downturn. Investors are closely monitoring these situations. They are assessing the potential impact on their portfolios. It's essential to stay informed about global events and their potential consequences. We'll discuss how to protect your investments from these risks. Market crashes are a stark reminder that what goes up can come down. Understanding past crashes can help us prepare for the future. These events offer valuable lessons. The stock market has experienced many crashes throughout history. Each crash has its unique causes and consequences. However, there are common threads that we can identify. By studying these events, we can learn to identify warning signs. We can also develop strategies to mitigate risk. The key is to avoid repeating past mistakes. We must learn from the experiences of previous investors. The dot-com bubble of the late 1990s is a prime example of irrational exuberance. Investors poured money into internet companies. Many of these companies had no profits and questionable business plans. The bubble burst in 2000. This led to a sharp decline in the stock market. Many internet companies went bankrupt. Investors who had bought into the hype suffered heavy losses. The dot-com crash taught investors about the dangers of speculation. It highlighted the importance of valuing companies based on fundamentals. This includes earnings, revenue, and cash flow. The 2008 financial crisis was a different beast. It was triggered by a collapse in the housing market. This was fueled by subprime mortgages and lax lending standards. The crisis spread to the financial system, leading to the collapse of Lehman Brothers. It also resulted in a government bailout of other major banks. The stock market plummeted. The 2008 crisis demonstrated the interconnectedness of the global economy. It also highlighted the risks of excessive leverage and deregulation. The crisis led to stricter financial regulations and greater risk aversion. Diversification is key to protecting your investments. It's a simple concept. Don't put all your eggs in one basket. If you invest all your money in one stock and it plummets, you'll lose big. However, if you spread your investments across different assets, you reduce your risk. Diversification is like an insurance policy for your portfolio. It helps protect you from catastrophic losses. It won't prevent losses altogether, but it can cushion the blow. Asset allocation is the process of deciding how to divide your investments. This should be based on your risk tolerance, time horizon, and financial goals. There are many different asset classes to choose from. These include stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics. Stocks offer the potential for high returns, but also come with higher risk. Bonds are generally less risky than stocks, but offer lower returns. Real estate can provide diversification and income. Commodities can hedge against inflation. Section 3. Rebalancing your portfolio. Once you've allocated your assets, it's important to rebalance your portfolio periodically. This means selling some of your winners and buying more of your losers. Over time, some of your investments will perform better than others. This can throw your portfolio out of balance. Rebalancing helps you maintain your desired asset allocation. It also forces you to buy low and sell high. This is a disciplined approach to investing that can pay off over the long run. Rebalancing is an essential part of diversification. Section 1. Seeking shelter. When storm clouds gather in the market, investors seek safe havens. Safe haven assets are investments that tend to hold their value during times of market turmoil. They provide stability and peace of mind when other investments are plummeting. These assets are typically less correlated with the stock market. This means they don't move in tandem with stocks. When the market falls, safe haven assets may remain steady or even increase in value. It's important to note that no investment is completely safe. Even safe haven assets can fluctuate in value. However, they are generally considered less risky than stocks during market downturns. Section 2. The allure of gold. Gold has long been considered the ultimate safe haven asset. It has been a store of value for centuries. Investors flock to gold during times of economic uncertainty, geopolitical instability, and inflation. Gold is a tangible asset. It's not subject to the whims of central banks or governments. Its value is driven by supply and demand, and it has intrinsic worth. This makes it a hedge against inflation. When the value of paper money declines, gold tends to hold its value. This makes it an attractive investment during inflationary periods. However, gold prices can be volatile in the short term. The stability of Treasury bonds is a crucial aspect to consider. U.S. Treasury bonds are another popular safe haven asset. These bonds are issued by the U.S. government and are considered one of the safest investments in the world. Treasury bonds are backed by the full faith and credit of the United States, making them highly unlikely to default. Investors view them as a safe place to park their money during times of market stress. When stock prices are falling, investors often move their money into Treasury bonds. This demand drives up bond prices and pushes down yields. This inverse relationship between bond prices and yields can provide a buffer against stock market losses. Even with diversification and safe haven assets, market downturns can still impact your portfolio. That's where stop-loss orders come in. These orders act like safety nets, helping you limit potential losses. Imagine you buy a stock at $50 per share. You set a stop-loss order at $45. If the stock price falls to $45 or below, your order automatically triggers a sale. This helps you avoid further losses if the stock continues to decline. Stop-loss orders are essential tools for managing risk. They take emotion out of trading decisions. This helps you stick to your investment plan, even during periods of market volatility. Using stop-loss orders requires discipline. It's tempting to move your stop-loss lower as a stock falls, hoping it will rebound. However, this can backfire. It can lead to bigger losses if the decline continues. It's crucial to set your stop-loss order at a level you're comfortable with and stick to it. This level should be based on your risk tolerance and the stock's volatility. Remember, stop-loss orders are not foolproof. They won't protect you from every market downturn. However, they can help you manage risk and avoid emotional decision-making during turbulent times. While protective measures are crucial, a long-term mindset is equally important. Market downturns are a natural part of the economic cycle. Panicking and selling all your investments during a downturn can be detrimental. It can lock in losses and cause you to miss out on the eventual recovery. Remember, time in the market is often more critical than timing the market. By staying invested and riding out the volatility, you give your investments the opportunity to recover and grow over the long term. Cash is king, especially during a stock market downturn. Having cash reserves provides flexibility and peace of mind when markets are volatile. Think of it as your dry powder, ready to be deployed when opportunity knocks. When markets fall, prices drop. This creates buying opportunities for those with cash on hand. You can purchase stocks and other assets at discounted prices, potentially boosting your returns in the long run. Cash reserves also provide a financial cushion during uncertain times. If you lose your job or face unexpected expenses, having cash on hand can help you weather the storm without having to sell investments at a loss. While having cash reserves is essential, it's crucial to strike a balance. Some investors believe in market timing, trying to predict when to buy low and sell high. However, this strategy is notoriously difficult and often backfires. Instead of trying to time the market, focus on time in the market. This means staying invested for the long term, riding out market fluctuations, and letting your investments compound over time. Consistently investing over time, even small amounts, can lead to significant wealth accumulation over the long run. Remember, the stock market has always recovered from downturns, and those who stay invested typically benefit from the eventual rebound. Summarizing the key points discussed, it's clear that market downturns are an inevitable part of the investment landscape. Understanding the current market situation, learning from historical crashes, and employing protective strategies are essential steps to safeguard your portfolio. Diversification emerges as a cornerstone strategy, spreading risk across various asset classes like stocks, bonds, real estate, and gold. Additionally, safe haven assets such as gold and treasury bonds provide stability during turbulent times. The importance of stop-loss orders cannot be overstated. These tools help limit potential losses and remove emotion from decision-making, ensuring that your investment plan stays on course even in volatile markets. Maintaining a long-term mindset is equally crucial, as this helps you withstand short-term market fluctuations and capitalize on eventual recoveries. Panic selling during downturns can lead to missed opportunities and locked-in losses, whereas staying invested allows for potential growth over time. Lastly, keeping cash reserves provides a financial cushion and the flexibility to take advantage of market dips. This dry powder can be deployed to purchase discounted assets, enhancing long-term returns. It's essential to balance cash reserves with ongoing investments, focusing on time in the market rather than attempting to time it. Consistent investing, even in small amounts, can lead to significant wealth accumulation over time. Remember, while market downturns can be daunting, they also present opportunities for those who are prepared. By diversifying, protecting your assets, and maintaining a long-term view, you can navigate uncertain waters and come out stronger. Engage with us in the comments below, share your thoughts and concerns, and don't forget to subscribe for regular updates on market trends and investment tips. The journey of safeguarding and growing your investments is a continuous one, and staying informed is your best strategy.